All right, so let me start off on the world economy. And it might sound trite, but one of the things that's really important is you know where you're starting from, okay? So, yes, we build big fancy models of all the global economies, etc. But what I'm trying to show you here is what we call a leading indicator. So what is it? It's trying to show what's happening to global growth, and we're trying to say, well, we would love to know where we are now and where we're going to be in the next 3 months. So what's in it? We say up there, but basically think global shipping, think of global air freight, think of some of the leading indicators coming out of China and Asia. What does the graph show me? What it says is the global economy is sort of running along pretty flat at 2.75%. It's not showing any signs of a big slowdown, but it's not showing any signs of a big kick up. Now, context, 2.75%, global average is around 4. So if I'm using a motor car sort of analogy, I've got 6 cylinders and probably I've got 2 cylinders working really well. I've got 4 that are not. The other thing that I think is important is most of the big international organisations like the IMF and the OECD have a hockey stick next year. We don't believe that. So we think the global economy is sort of going to stumble along roughly where it is. The other issue that we get asked all the time, although people are starting to get less worried about it, is Brexit. Has that caused a lot of problems? So, first thing I'd say to you is, and I'll probably have to apologise to the POMs in the room, you're 2.4% of the world. Okay, you're not a lot. From an Australian point of view, you're less than 3% of our exports. Our exports are mainly wine and essentially the UK tourists coming here. The big issue is not whether or not the UK is going to be hurt. It probably is, we think. Why? Because people are uncertain what's going to happen. And so if you're not really sure what's happening, what you tend to do is you tend to sit on your hands. And the assumption is that maybe you'll get a technical recession in the UK. Instead of growing at around about 3% this year, they're probably going to grow something like 2%. And next year, instead of growing something like 2.5%, they're going to be growing 1.5%. So it is a technical recession, maybe, but it's not big enough to have any big impact on the world. It'll probably have a bigger impact in Europe next year. Where you get nervous is if it gets into the financial markets. In other words, if you scare the hell out of people in the equity markets, the funding markets for banks and international organisations close. That's where you get into trouble. You also know that policymakers aren't really sure what's going to happen, and so they're going to be careful. So, for example, the Bank of England last month dropped their rates from 0.5 to 0.25, which is actually the lowest rate they've had since they've been in operation, which I think is 360-something years. And they said, by the way, we're going to cut again. I think more importantly, RBA is going to be looking, Fed's going to be looking. However, you do need to think of the context of this, and that is they're not even going to start talking about Article 50, which is the article they have to basically say we're exiting, until they're sort of ready. I think Theresa May was saying, oh, we're not going to do it until the end of the year. Now the Europeans are saying, well, we don't want to do it before the Italian and the French elections, so you might be looking at it 12 months before you even start. And then they tell me that the lawyers say it could take 4 or 5 years. So it's a really long-term thing. So has it got into the financial markets or not? And the answer is no. So if I'm looking at this chart here on the left-hand side, that is in red is a composite of global equity markets. Black is the Australian equity market. And what I've tried to do is put a circle around the week that Brexit occurred. And what happened is the week after Brexit occurred, the equity markets were back above where they were before they started, outside of the UK. And then the right-hand side is basically what's called the VIX, which is a fear index. They actually trade a fear index out of Chicago. And the sort of little spike up there, which I've circled, was Brexit. A week later, it's all gone. And in fact, that index is, if you updated it, so that's last week's index, if you update it, it's now actually the lowest since 95. So there's not a lot of fear out there associated with Brexit. Could it still go wrong? Yeah, it could still go wrong. How might it go wrong that you might not be expecting? Some bank or some hedge fund or something might have been long pound going into. In other words, they may have been betting the pound was going to go up. Because remember, everybody assumed it was going to essentially not happen. So that will take some time to work through. But at this stage, we're not seeing any sign of it. So it's an issue for the UK, it's an issue for Europe probably next year, but it's not an issue for Australia. There are, if I'm sort of go back to my motor car analogy, and my two engines, the two engines that I think are really important for Australia are basically China and the US. The others, Japan's going backwards again. Brazil should be growing about the same pace as China, i.e. around 7%. They're -1. Trade is really weak, and what you're seeing is surprisingly weak trade, even given the weak growth in GDP. So there are a lot of negativities out there that you could get very worried about, but from my point of view, from an Australian point of view, unless you cause some problem in the financial markets, then you sort of don't care. So I'm going to talk a little bit about China. You always have to be careful with the Chinese data because quite often a lot of people say they sort of lie. But also one of the other issues is they publish quarterly GDP and they publish annual GDP, and guess what? They don't add up. So it's 6.2 if you add up the 4 quarters, it's 6.7 if you add up the annual number. So we look at other things. So for example, construction, on the left-hand side there, buildings, etc. There was a kick-up in the first quarter. Why? Because the Chinese actually fired up the banks. Chinese credit growth in the first quarter of this year increased to something like 40%. Okay, so they said, go lend, guys. Now, in an Australian context, there'd be a hell of a lot of bad debts, but in the Chinese context, there's a lot of bad debts, but the government picks them up. The other thing on the right-hand side there is the usage of steel. The red line is the growth rate. What I'm trying to show you here is in China particularly, you're not seeing any growth in steel. In fact, China is essentially bringing in the iron ore, producing steel and then re-exporting it. Also, if you look at the amount of energy that's being used in China, electricity, it's actually negative in terms of relative to last year. So there are some differences, and people do tend to focus on these numbers and say, I really don't believe the GDP numbers, they're really more like 2. But that's not true. A really important chart, which is really boring, is the left-hand side here. Think of an economy. Every economy in the world has 3 sectors. Sector number 1 is the primary sector, which is down the bottom in black. Sector number 2 is the secondary industry. So that's basically industrial production, construction, use of steel, sort of thing that you need iron ore, coal, etc. for. And in blue, what you can see, it's clearly slowing as a percentage of the economy, big time. So if I'm in Western Australia and people say, is China falling over? I say the part that you're trying to export to is. However, the red line is something different. The red line is the tertiary sector. That's essentially services, education, legal, tourism, all that sort of thing. That is 55% of the Chinese economy, and it's growing strongly. So what you've got in China, if I'm looking at China and say, is China likely to fall over? Is it a bubble? No. If you're a miner expecting to sell more commodities at a higher price, it ain't going to happen, is sort of the bottom line. So from an Australian point of view, we're still going to be sending a lot of our iron ore over there. We're going to make not a lot of money out of it. But from an Australia in the medium term, the prospects are more about education, health, tourism, apartment buildings, etc., etc. So I look at China and I feel pretty relaxed about that. In terms of, so on the right-hand side, we've just got some growth numbers there. The other thing I'd say about China is it's not just the growth that matters, it's the level of activity. So China growing at 6.75% today generates more GDP than it did when it was smaller and growing at 10. So context, I just said the UK is 2.5%. The Chinese economy by itself is 18% of the world economy. The other big one is the US. Left-hand side is the latest set of GDP numbers. So what are you getting? Reasonably slow growth in the US. Currently it's growing around 1.5% to 2%. If you look at that big black line there, that's saying essentially that the consumer in the US is growing around 4%. So on the right-hand side there is just looking, red is GDP and you can see the big slowdown. Black is slowing, but nowhere near as much. That's the domestic part of the economy. So what you've got in the US is a consumer who's feeling pretty happy. You've got no growth in stocks and you've got no growth in net exports, because the world's not so good. So when we look at that sort of story and we look forward, what we basically say, based on some of the models we do, and I've just put up one here, the red line is sort of our model. What we're saying is that the US economy looks pretty good to be growing at around 2%. And it's starting from a base where the unemployment rate is 4.8. Okay? So when we look at the US, what are they going to do? I think they're going to be increasing rates relatively soon. However, they're always nervous about getting a weak number. The Fed is out there and there's a big meeting of central banks over the weekend, and everyone will be looking at what the Fed's going to be saying. They've sort of sent some messages that next meeting, which is September, might be live. I don't think that's likely. I don't think they're going to do anything until they figure out whether Trump's won or not, because that sort of might make a bit of difference. I think more realistically, what you're probably going to see is an increase in rates towards the end of the year, but very slowly. So that's sort of our sort of chart. If you look at as you're looking at it on the right-hand side there, that's our growth forecast about where the Fed might be over the next 3 to 4 years. So what we're saying is they will go really slowly, really carefully. They might get their Fed funds rate up to 2%, maybe not. Normally the Fed funds goes to about 4%. So really slow. If there's any signs that the US economy stutters at all, any signs of Brexit coming through, they're not going to do anything. But our general assumption is that they will start increasing because, unlike Australia, you're finally starting to get some wages growth in the US. Okay, so globally it's really patchy. The two engines that I sort of think are really important are okay. The rest of them I'm sort of worried about, and I still see global growth running along roughly where we are.